Hey guys, so as a new investor, the best way that anyone can start building money in the stock market while having a diverse portfolio is investing into ETFs or exchange traded funds. Even as someone like me, someone that can only invest $30 a week at this point, I've still had the opportunity to make a decent amount of money investing long-term into ETFs. So in this video, I'm gonna go over with you guys 3 different ETFs. I'm gonna show you why they're beneficial for low budget investors, and then make sure you stick around to the end because I'm gonna share with you guys what the potential could look like when it comes to portfolio growth and dividend income after investing $10, $20, and $30 per week for 20 years. Okay, so first up we have VIG, which is Vanguard's Dividend Appreciation ETF. This one tracks companies that have raised their dividends for at least 10 years straight, so it's all about consistency and long-term growth. VIG holds over 300 different stocks, making it the most diversified of the 3 ETFs I'm going to cover today. You'll see a mix of tech and financials leading the way, but also healthcare, industrial, and consumer defensive stocks, so you get both growth and stability. Some of those top names are going to include Broadcom, Microsoft, Apple, and JP Morgan. What I really like is how affordable this position is to hold. Its expense ratio is only 0.05%, meaning if you had $10,000 invested, you'd only pay about $5 per year in fees. That means more of your money can make more money over time. Now, the dividend yield is a little on the lower side at 1.68%, but here's the key. The dividend growth rate has averaged over 7% per year for the last decade. That's the real power here. Compounding income over time, even if it starts small. Performance-wise, VIG has nearly tripled investors' money in the past 10 years. It's not about big payouts today. It's about consistent growth that builds a stronger foundation for the future. That's why I hold VIG in my Roth IRA, and it's been one of my most reliable positions. Next, we have SCHG, Schwab US Large Cap Growth ETF. Now, unlike VIG, this one isn't focused on dividend growers. Instead, it tracks large cap growth companies, meaning the biggest and fastest growing US stocks. SCHG holds around 230 stocks, with the majority in tech, companies like Apple, Microsoft, and Nvidia. So it's definitely growth heavy, but that's where the returns have come from in the past decade. Fees are also super low at 0.04%, so every $10,000 invested only costs $4 per year. Really hard to beat that. Now, the dividend yield here is almost non-existent. It's less than 0.4%, but that's because companies in this ETF actually reinvest their profits rather than paying them out in dividends. And it shows. SCHG has more than tripled in the past 10 years. So if you're a low budget investor and you're not as concerned with dividend income right now as much as you are with long-term growth, then SCHG can be a great dividend ETF complement to other ETFs. And finally, we've got QQQI, the NEOS NASDAQ 100 High Income ETF. This one's interesting because it mixes growth with an option strategy to actually generate some additional income. Basically, the fund owns big tech names like Apple, Microsoft, and Amazon, but it also sells covered calls. That's a way of generating extra cash from the stocks it holds. The trade-off is, while you do get some higher income, you lose on more opportunities if the market happens to rally too fast. Because of this strategy, QQQI pays a massive dividend yield compared to the others in the double digits. That makes it really attractive for investors who want cash flow today, not just growth later. The downside is taxes. All this income is classified as return on capital, which can lower your cost basis. That can be beneficial for the present time, but it could cause a bit of a problem the longer you hold it. So QQQI is less about long-term compounding, but more about maximizing income right now. Now, that's all great, but as a low budget investor, what's important for me is what a position can do with my money in the long term. So again, we're gonna go over 3 hypothetical situations, assuming you invest $10, $20, or $30 every single week into each of these positions for the next 20 years. And this is what possibly, and keyword possibly, could happen to your portfolio based on how much it could be worth and how much you could be making in dividends per year starting with year 20. VIG gives you a super stable foundation. You don't get the crazy dividend payouts up front. In fact, the income is the lowest here. But what you do get is steady dividend growth and strong long-term compounding. That's great for someone that's starting with low weekly investments because you're building a reliable portfolio that's going to grow with you. SCHG is all about growth. I mean, look at that portfolio value, over $1 million from just $20 a week. Keep in mind, that's just assuming the 37% growth per year continues as it has been on average for the past 10 years. The trade-off, however, dividends are almost non-existent, so you won't be living off income here. For the low budget investor that just wants to maximize income growth, This is it. QQQI is the exact opposite, or almost the exact opposite. The portfolio growth is much smaller, but the income is insane. Even at $10 a week, you're looking at almost $13,000 potentially in annual dividends after 20 years. This is powerful for investors that are looking for that income sooner rather than later, even though you are going to sacrifice some portfolio growth over the long term. So to put it simply, VIG is going to be your steady growth and reliable compounding. SCHG, big long-term growth, little dividend income. And QQQI is going to be kind of in the middle. High income growth, but slightly high, not as high portfolio growth. But that's the beauty of it. As a low budget investor, or as an investor in general, you can pick one of these three positions, whatever you feel like benefits you and your goal for your portfolio, or you can actually combine all three into one portfolio to give you that healthy combination of high income from dividends, but the opportunity to make long-term profits. Let me know in the comments below, which one is your favorite ETF and why? Which one do you feel like benefits you for your goals and your portfolio? I'm actually kind of considering some of these. VIG again is one I have in my Roth IRA, but I'm considering also maybe having it on my regular portfolio, that or maybe SCHD, but I really got to do some work with my portfolio as well. But it's doing pretty well so far. I actually made a recent video about how my portfolio performed in the month of July, so make sure you guys check that out when you have some time. I appreciate you guys watching this video, and until next time, as always, take care.